corporate earnings guidance is robust and interest rate cuts are coming, just not this week. Good morning and welcome back to Morning Markets here at True Potential. This is a very important week for markets. As you've heard from my colleague Paul Durrans, we've had mixed updates from corporates regarding earnings, but guidance appears to be a bit firmer than markets were expecting, and that's allowing some of these consumer brands such as McDonald's and Starbucks to rally in the equity markets despite disappointing in some of their earnings, and that's because their guidance is surprising markets. They're a little bit more optimistic than analysts were expecting. But the main news this week is going to be the monetary policy meetings from both the US Federal Reserve and from the Bank of England tomorrow. It's important because both central banks are unlikely to do anything and keep interest rates on hold as they have been for the last 12 months. However, in their press releases, they are likely to indicate that there has been more progress made in getting inflation back towards target. And that's important because it really signals these central banks are laying the groundwork for beginning to cut interest rates, possibly in early autumn. Now, if we think about the progress that has been made in inflation, we've seen inflation fall by over 50% in the US over the last 24 months, such that the inflation reference that's important to the Federal Reserve has fallen to 2.6%. And it's only really some measures of rental inflation which is stopping inflation there decline towards 2% and even below. And of course, the Bank of England here in the UK, we know that inflation is actually at 2%, having fallen from over 10% over the last 18 months. Bang on target. So what is stopping both central banks from cutting interest rates, given we've seen the Bank of Canada and the European Central Bank cut interest rates already? Well, it's the so-called scarring effect from the rise in inflation pressures through 2021 and 2022. Whilst most central banks had little power to stop the rise in goods prices and energy prices, still didn't shield them from criticism for failing to raise interest rates quickly enough. So they're likely to prolong interest rates at these levels for a bit longer. However, not all central banks are thinking about cutting interest rates. Overnight, we've had the Bank of Japan increase interest rates to the highest rate in over 15 years. Interest rates were raised from 0 to 0.25%, and that's despite inflation there falling as well. It's more likely a reflection that the Bank of Japan would be more comfortable with a much lower inflation pressure than they're currently seeing. Whilst inflation did rise briefly above 4% in Japan, it's been somewhere around about but below 3% for the last 2 years. But in Japan, they're likely more comfortable with inflation above 0, but closer to 1%. Certainly don't appear to have the desire for 2% inflation that we have here in the West. So the Bank of Japan signalled that interest rates are likely to rise further over the rest of the year. That likely means that there's going to be another interest rate increase to around about 0.5% in the autumn. But this again just reflects a healthier economic backdrop than had been expected a short while ago. So on the whole, in summary, interest rate cuts are likely to come from the Bank of England and the US Federal Reserve in September. That's likely to signal that there will be further interest rate decreases beyond that, but they're likely to be gradual for as long as inflation continues to be above 2%. That's all for today, but please join us tomorrow where we'll update you on the US Federal Reserve outcome. Thank you.